And the second webinar of the AAE Risk Management Committee. And today it's Malcolm Kemp and myself showing you two topics which are currently, from our perspective, very important and interesting to discuss. So that's the agenda for today. I will start just after the very brief introduction with presenting on COVID-19, how to survive the pandemic as a risk manager. And then after that, Malcolm Kemp will present on Solvency II risk margin and give an update on current developments. What we want to do is, as we want to have the presentations follow up in these 45 minutes each, we want to have just afterwards the Q&A together, Malcolm and myself answering your questions. So what I will do is, during the presentations, I will look into the chat. So if you have any questions to us, you want to discuss with us afterwards, please write them into the chat function of the GoToTraining, and I will copy those questions then into the presentation, and Malcolm and I will go through them after the two presentations. So, Malcolm, anything you want to share before I start?
I just want to say welcome to everybody who's joining. We can see quite a few people joining already, and we're looking forward to great interaction. Do please remember to come up with questions, to put them through the chat, and we'll endeavour to answer as many as possible during the time available. Thank you.
Excellent. So let's start with the first presentation. I will just switch off my camera, and so here we go. So you should see now my screen. So the question really is, well, how to survive as a risk manager. That's exactly the question. Well, the first thing is, if you want to survive, you don't die. The second question is, well, if you don't die, you have to cope with the pandemic, and that's perhaps another tricky and difficult task to do. And what I will discuss with you today is what have we learned during the pandemic as risk managers, especially what are ways of managing this pandemic, these risks, and what are the problems we just observed during or experienced during the crisis. And with what I wanted to start is actually the first approach we had as risk managers modeling the pandemic. The ones who have done the zero training perhaps have already seen in one of the first trainings we discussed the topic emergent risk and how to tackle these risks in one approach of how to model pandemics. And what you see here is actually a slide we also used for the zero training in 2011. And well, obviously, a pandemic, when it comes, what happens there, typically you have a high number of sick and dead people, and that means in the first instance a loss in health insurance, a loss in life insurance. So that's what we expected as risk managers. As a second consequence for that, you will see that, well, as people die or become ill, you have a problem with your employees and your customers. So for the employees, you need your business continuity management. For customers, you will see an economic breakdown. And that could mean that, well, there might be a loss in credit insurance, but also on the asset side. And then also, as the economy is really in trouble, you have losses in equity. So that's like the direct consequences. Typically, what then happens is you will see governmental interventions. So for instance, what was expected already in 2011 was that airports will be closed. Then you again have losses in business interruption or business continuity insurance. On the other hand, there will be a production in medicines and vaccines, and then perhaps you might see profits and loss in pharma. So this overview you see here on this slide is a very brief description of the scenario we discussed during the 2011 training of CIRA. And by the way, it's very similar to scenarios that have been discussed in the end of 2009, 8, 9, 10, 11. So those scenarios were quite typical. So for instance, the Robert Koch Institute, that's the health institute in Germany, they had similar scenarios, and the order or consequences of a pandemic were in a similar order. Scenarios typically also driven by reinsurers or modeling firms were more or less similar. So there was a certain agreement between all risk managers that if a pandemic happens, it will look like that. So what really happened during COVID-19 was completely different. What we've seen was, well, there was a pandemic, it started, but before we saw the high number of ill and death people, luckily the government intervened and we had a lockdown. So the pandemic itself, when you look at the left side of this graph, of this picture, you see that actually the sick or the dead people weren't that much of a problem at the beginning. We even had in many of the European countries during 2020, we had profits in health insurance as people didn't go to the medical doctors in that frequency as they used to go the years before. And they kind of moved on their perhaps medical examinations or treatments to a later time over the year, or then even postponed it to 2021. So in many countries, you see profits in health emerging. You have a certain neutral development in life insurance. Well, we have observed deaths in all the countries in Europe, but it was more or less neutral in life insurance in many of the European countries. And obviously also the number of employees and customers as casualties were rather low, and the BCM during the lockdown was quite successful. So even as we had to stay at home and work from home, we were able to do so due to the implementation of the digitalization the last few years. The BCM was quite successful. On the other hand, the losses actually were driven from the lockdown. So it was not the direct implication of the pandemic, but more the indirect coming from the lockdown, where we just observed economic losses as many of the companies, factories had to lock down, had to stop working. The production had to stop, sales had to stop, many of the shops had to be closed. And as many of the governments also supported these industries, we have not yet seen big losses in credit and credit insurance, but we have seen profits and losses in equity, and we have seen also quite huge losses in P&C, what we haven't expected in our scenarios. And those losses, especially some profits, for instance, in motor insurance, as people didn't drive that much in that time of period. You haven't had these accidents, you haven't had theft, for instance, but then you had losses, especially in credit insurance to some extent. You had business closure insurance, event insurance, and those led to rather remarkable losses in P&C, which haven't been expected to that extent. Till now, research is still going on. Well, we've just seen that we have the first vaccine in the UK, which is now open for treatment, but still the development is rather neutral. So perhaps we will see some profits in pharma, especially coming next year. Hopefully the vaccines are successful, and we will be able to at least stop or mitigate the risks of the pandemic. So what you see here is that we as risk managers, we kind of planned or expected a certain scenario to develop, but reality completely looked differently. And that's exactly the problem what we are facing when we manage these scenarios or these extreme events like a pandemic. And it's not just a pandemic, it might even be for other situations as well, for other emerging risks. So what especially makes a pandemic so difficult to manage? I have 3 slides for you to explain 3 main difficulties we are facing during a pandemic, to discuss these effects. Well, let's first have a look at governmental measures, what we've seen there. What you see on the right-hand side is the development of the pandemic actually in Germany. So what you see here is the solid line, the yellow solid line. That's the number of infected of the COVID-19 pandemic starting 1st of March till mid of the year, end of June. So the numbers after the first peak kind of stabilized quite quickly, and they were stable till actually end of September, mid of October, when we just had the second wave in Germany. That was possible as the reproduction rate, which was quite high at the beginning, around 3. So that was the typical number we observed in many countries, that the reproduction rate, that means how many people are in average infected by one person who was infected. So in average, it was at the very beginning of the pandemic 3 people being infected from one person. That was driven by the measures implemented by the government, by the lockdown especially. That was driven quite quickly down to numbers mid of April below 1. That means the spread of the pandemic slowed down quite quickly, and we had this stabilizing effect on the infected. That means till mid of the year, we had around 200,000 infected in Germany, and around 7,000 deaths. Around 7,000 deaths. What would have happened, just as an example, is a scenario if the measures weren't implemented that effectively. So if we had a reproduction rate of, instead of, as we observed, below 1, we had still quite low reinfection factor of 1.5. So that's the dotted line here. And when you just model the number of infected with this R factor, you see that it will still grow exponentially. And instead of 200,000, you have more than 11 times more infected. That means 2.2 million instead of the 200,000. And the maximum infected per day was not 7,000 a day, but 44,000 a day. And you can imagine what that would have meant for medical care and for hospitals to take care of all these infected people. The number of deaths would have been much higher than what we've observed in Germany, luckily. So that means, as we don't know how the governments will react, we have really a hard time to predict how the casualties will develop over time. That's exactly what we currently observe in many countries. So for instance, in Germany, we are already, or still again, in the lockdown. In other countries like UK, you just came out of it. Last week was the lockdown ended, so you kind of survived the second lockdown. The question is, what does it mean? So when will the next lockdown come? Will we observe increasing numbers, exponentially growth in the meantime again? And then how will the government react again? How much value will be given to the economy versus the casualties, the persons becoming sick or dying during a pandemic? And that's exactly a discussion which has been tackled differently in the different countries in Europe. And that's something that we will also discuss later on some of the other slides. Then the second thing what we observed is also, I would call a secondary effect of the pandemic. That's the economic development, or the capital market development. What you see here is, on the right-hand side, you see the development of the Euro Stoxx 50 in 2020, you see that it started around 3,700. The highest point was in February, around 3,865. And then actually within 6 weeks, it dropped during the pandemic to 2,386. So that's the lowest point we had. So within very few weeks, it just dropped very quickly, about 38%. Actually, that's exactly the scenario which is used, or 39% actually. That's the scenario used under Solvency II for a 200-year event. But then, luckily, the Euro Stoxx and the European economy actually recovered. And when you look at what the current status is, so we are around 3,500 already back. So we are more or less at the same level as before. So the 100-year event hasn't luckily realized as the economy has recovered, and also the Euro Stoxx has recovered, and we just had seen this high volatility within several weeks, and then a rather quick recovery, with actually a second smaller downturn coming from the second wave we have observed now in many countries in Europe. Again, what we see is that the economy perhaps has even overreacted in the first wave. In the second wave, we see that the investors were perhaps a bit more cautious in buying or selling at that time, first selling stocks. So there was more trust in the government and in the economy to survive such a pandemic. But then when it came for the first time, we had this huge drop as there was a huge uncertainty and not enough trust in the economy to survive, to recover after such a pandemic. So this uncertainty and then this not being able to predict what's going to happen really led to this huge uncertainty here, and then also this huge unstable development, huge volatility we observed in these 2 months in February and March. Again, which is a problem for us as risk managers, how to manage these risks, as we cannot really predict how market participants will react in these different situations during a pandemic. So we've observed 2 waves now already, and the 2 waves were actually treated differently by the market. And then it's even worse actually. So even if we knew everything, even if we knew how the governments will treat the pandemic, how measures will be implemented, and even if we knew how the market will actually behave during a pandemic, we have another problem really coming from the pandemic itself. And what you see here on the right hand side is the years, and well, you see here a long-term behavior of the pandemic. So starting from 60 years up to 110 years. So it's really the long-term development of a pandemic. And you see here the prevalences. And what you observe is that you have really unpredictable prevalences over the time. So you have always peaks, and it's really not really possible to predict when is the next peak to come and to what order of magnitude will be the next peak. And this is also seen here. It's kind of a diagram where we see here the susceptibles, so the people being prone to be infected, and they're the infected. And you see the development over time just in such a graph. And you see that it's not an attractor, which is typical if you have a deterministic system, where in a deterministic system, everything would just converge to a single point, or have like a cycle, like a cyclical development. So that's not what's seen here. So what's called, in that sense, it's called a strange attractor, which is just an example of a chaotic behavior of such a system. And it's not reality what you see here, it's just a model. So the model is typically simpler as reality. Such models as the typical models you use for modeling pandemics, and even the simple ones, these SEIR models, where you have suspectables exposed, infected, and recovered. So even those simple models, they have the features of non-linearity and a very difficult to predict behavior on single parameters. So if you just change a tiny bit parameters, the development will be completely different. And that's what we know as chaotic behavior. And then the result is this strange attractor you see here, which is really chaotic. So even if we knew everything, and if you have a perfect model, even then we cannot really predict in the long term. So that's one of the main features of such a pandemic, that it's a bit like weather on a different time frame. So weather we cannot predict perhaps the next 2 or 3 weeks. So for a pandemic, it's more long term, on the next year or 2 years. And then with interventions of the government, again, this instability just increases, and it's even becoming more and more difficult to predict in the short term, like for the next 1 or 2 or 3 months. So that's really the governmental measures that makes it so different than in reality to be able to predict what's going to happen. Such systems are known as VUCA, and that's perhaps many of you might know that already. You might have experienced such systems as risk managers. VUCA systems mean, or VUCA environments mean, you have high volatility, you have high uncertainty, the systems are complex, and the systems are ambiguous. That's what VUCA stands for. You cannot only have that from pandemics. It's typically, for instance, the economy is such a system. It's really not possible to really predict what's going to happen, and it's very difficult to manage in the long term. So you have to have different strategies to manage systems which have this VUCA feature. And the good thing about managing VUCA is you can manage VUCA again with VUCA. And managing VUCA with VUCA means, well, instead of volatility, you need a certain sense of a vision. So what's the target or the objective you want to achieve? Uncertainty you can tackle with understanding or clarity, and actually the topic on ambiguous you can really tackle with an agile approach, agility in managing the way forward. And again, it's VUCA, and I come to explain what VUCA could mean, especially for a pandemic, and how to manage a pandemic using these 4 acronyms or these 4 topics: vision, understanding, clarity, and agility, translated to the situation of a pandemic. But first thing is vision. The problem really is during a pandemic, and that's what drove perhaps also the uncertainty during the pandemic, also for the capital market. We as insurers, or the capital markets themselves, the companies, we had problems providing a vision of what's the potential outcome after a pandemic. And what we can do there as risk managers is we can really help positioning ourselves and the company with a risk profile, and then also the products and services that really fit to this perhaps new risk appetite or changed risk appetite, and what kind of solutions can we provide, how can we earn money with these new solutions. A main topic during the pandemic was reputation. So we saw in several countries, also Germany, that insurance companies really discussed in public if and how they should pay for certain claims. And this really destroyed for certain sectors the reputation, again, for insurance companies. It made it really difficult. And on the other hand, this could have been used as an opportunity to say, okay, we are reliable, we are stable, we know what we do as insurance companies. You can really trust that we can pay for the claims, and we are foreseeable, we are predictable in our behavior, and people can really rely on us as an insurance company. And last but not least, and something what we again learned during the BCM measures we implemented, it's everything, or it's all about processes and workflows. If we have digitalization and automation of the workflows, it's again an opportunity to improve the processes and also the efficiency and effectiveness of a company, which is again a vision which could come out of a pandemic as positive effect of a pandemic. Understanding a pandemic is actually first the problem of understanding what are the problems. So that's what we just discussed on the 3 slides before. But then it's not enough to only understand what is the problem. Why can't we predict pandemics? On the other hand, it's important to understand what are the key risk drivers, and then just to be able to implement later an agile approach, we have to monitor these risk drivers with a high frequency and understand dependencies, if possible, causal dependencies on a short-term basis, to be able to forecast what can happen at least for the next months to come, so that we are really able to have at least short-term forecasts available for our management. And then the problem really is, as we've just seen it before, long-term forecasts might be difficult because you have a huge funnel of uncertainty for these forecasts, but at least you will need a long-term analysis and then use scenario-based assessments to see how huge is this uncertainty and what could happen, and then we can at least try to manage with this uncertainty, knowing where this uncertainty lies, and then knowing how to manage the way forward. Not being able to predict perhaps what happens year end in February or in March or in April, but be able to use a method or a process of how to manage it during the year. For that, it's very important to have clarity. That means, and many of the companies implemented that, you need a crisis management team. So that's quite typical also for BCM, that they are clearly mandated persons within a company who run the processes and have the agreed mandate to make decisions without having to ask the full board, for instance, but be able to act more quickly and focused. Then it's important to have agreed priorities and an agreed timetable, what's possible when, what are the next steps. And obviously it's important for the long-term scenarios to understand, okay, if a certain scenario seems to realize, what are then the respective measures against it? And so those measures need to be made transparent to all people on a need-to-know basis. And again, people need to understand these what-if scenarios. So what should I do if certain things are happening, that we can really act quickly and focused in these different scenarios to be able to implement measures quite early on to prevent bigger losses. And what I've just explained to you is more or less the approach of agility, so that you plan in short time frames, understand what needs to be done in these short time frames, measure the success of these implementations of these measures you want to implement, and then learn over time and improve the measures and improve the processes, improve the products you're implementing. And a good way of understanding the principles of agility is the Agile Manifesto. That's something perhaps you might want to read later. You can find it under the link I have copied for you under the source agilemanifesto.org. For me, perhaps the 6 more important ones are, it's all about welcoming changing requirements. As the world changes, especially during a pandemic, you see new things develop, you see new effects coming from the outside. You have to welcome these changes, because that's something you need to implement, you need to understand, and you have to react on it. So it's not about moaning and about having concerns. It's really about, well, using the best you can do and get the additional inputs to improve your measures. Every step has to deliver also in a short term a working solution. It's not working if you're running from concept to concept to concept. All the concepts should already be in kind of a working mode, and by working you should test if these concepts are working. So it's not valuable to just have concepts, they should work. So there should be a prototype already available to really manage during the pandemic, because otherwise you cannot test if these solutions are working. Then what we've seen during the pandemic, all the different experts with the different perspectives, they have to work together, and if possible on a daily basis or a weekly basis, at least a short-term basis, because you need all the perspectives, all the experience from these different experts to really get a comprehensive and a working solution. Otherwise it wouldn't work. Communication is the best way to do it face-to-face. In a business continuity environment without meetings, that's a bit more difficult, but then still we had the possibility to have video conferences quite early on. So again, digitalization is very important to implement, and the new measures of working together. Then to do that, the best way of implementing it is self-organizing teams. So have a small team, but then help this team organize itself. So it's not a top-down decision or a top-down organization. It's the teams themselves who should organize and manage themselves and their solutions. That's working best. And how it works best is that these teams reflect on the learnings, reflect on their effectiveness, again on regular intervals, short-term intervals, to learn out of the pandemic and improve their measures and improve their tools. So that's really everything what I just explained, coming from the vision to understanding, clarity, agility. That's just the way forward of managing things on a short-term time frame and managing actually the way towards an uncertain future, and be able to manage the risks also during the time. The problem really is, and that's really therefore nothing we can just do for 2020 and then 2021 everything's done. So it's quite clear that this pandemic has come to stay. Even if we have vaccinations available, COVID-19 will be perhaps also in the future something similar to the annual flu we have to manage. And the problem we still see, and these quotations you see here, these 5 quotations are coming from a magazine, a German magazine, Science magazine. I've translated those. All of those come from articles in April and May, and they're still true. And that's something, again, what we have to understand. It's not so quickly as our understanding developed over time of the pandemic. So still a lot of questions are open. And perhaps two quotes I want to focus you on is the quote in the middle left. We have been somewhat lax in thinking about herd immunity. That's one of the things we have learned. There were different ways of managing pandemics, and one idea was, well, we could wait until herd immunity is implemented and everything's then okay. We only have to survive till herd immunity. That's something what we've just seen in Europe. That's really difficult, because on the way towards herd immunity, a lot of elderly people will die, and it's something which is difficult to decide on an ethical basis. So you cannot just say, okay, for the public it might be best if we could accept many elderly people die, because, well, people till 60 or 70 age 60 or 70 might not be affected that heavily from the pandemic. Something which is very hard to really decide critically. The second thing what I want to bring your focus on is the quote to the left and bottom. It turned out that all the things we were working on were not what we really needed. And that's from an expert for biosecurity. And he's one of those who actually developed these scenarios in after actually the SARS and the MERS epidemics, end of 2008, 9, and 10. They discussed what kind of scenarios could happen. So how should we prevent even or prepare for pandemics in the future? And all their scenarios weren't working. So it was really a worldwide effect that people weren't really thinking properly how to manage these risks. So it's not really predictable. It's very hard to really have the right idea of how to tackle these problems or these scenarios when you're not in the middle of it and when you don't experience what really is the problem. And saying that, that's also something we perhaps as risk managers need to have in mind when we manage other emerging risks, for instance, risks like climate change. Again, that's something which is not really predictable. It will develop in a very long term, and we have to manage these risks as well. And the question is, how should we do that? And how can we make sure that we are not really working on the wrong topics all the time before it's too late? So that's something really important for us as risk managers to manage and to tackle. Now have a look at the development, and let's very briefly discuss what have we learned when we look at different countries. How have these different countries managed the pandemic, and what does it mean for us also for the future? So what you see here is the development of the daily new confirmed COVID-19 cases per million people in that respective country. And you see 6 European countries, so Sweden, Austria, Italy, Netherlands, Germany, Spain. If you don't see your country, doesn't mean that there's something wrong with it. It was just chosen as these developments are quite different in these different countries, and I wanted to discuss it with you briefly, but what does it mean? So perhaps the country that sticks out most is Sweden, so that's the green one here. You see that actually during the pandemic, except for all the other countries who have peaked in mid of March and or beginning of April, and then just dropped down back to incidence rates of something about below 10, at least 5 to 10 cases per million people. Sweden more or less stayed stable over time. So at the very beginning, actually they tried to achieve herd immunity, and only later they saw that it's not working, and they stopped really striving for this herd immunity. And in autumn this year, they are more or less following the same paths as other European countries, and the numbers increased even to similar effects or similar levels as in other European countries. Currently, Sweden is actually the country with the most daily new confirmed COVID-19 cases in this group of 6 countries. So this idea of achieving herd immunity obviously hasn't really worked out for economic and or political reasons. So that's something we still have to look at. Then a second effect, what you see here is Italy. You see Italy started actually as the earliest country, but then managed to make the bend of the curve also quite early, and now manages the crisis quite well. So they were at some time they have the lowest numbers in Europe. So people were they took these measures quite important, and they really implement these measures. The public implemented those measures quite strictly, which helped them to, at least for the second wave, have this the effects of the second wave rather late than earlier. Like other countries, for instance, Netherlands, they had a second wave coming quite early again, and then perhaps even a third wave after the second wave developing quite early, and then currently it's stopped down. The highest numbers were seen in Spain, and they also had a second wave coming quite quickly, but now they have the lowest number actually in whole Europe. Obviously, the measures are now effective, and they manage a certain downturn in the new confirmed COVID-19 cases. And what you see, for instance, for Germany, my home country, so we are somewhere in the middle, perhaps on the lower side, but still nothing special about Germany or Austria. Austria, perhaps on the other side, in the second wave, they had the highest peak actually compared to the other countries to survive and to manage. And that's also something where what we know, Austria struggled a lot. They implemented quite late measures for the second wave, and that meant that as they were perhaps too late, they had to manage this high peak, because typically you need like 2 weeks before measures are really effectively working after implementation. What does it mean for mortality rates? And there you see that the situations are very different in the different European countries. What you see here is on purpose the Z score, which means it's the normalized standard deviation of the empiric standard or empiric mean. So everything's around 0 centered, and if you have values above 2, means that you have, compared to the average fluctuation, you have 2 sigma. Then you have values above 4, which means then it's significantly different from the average, from the empiric mean. You have a deviation of 4 sigma. So every deviation above 4 is seen to be significant. And what you see here, again, the 6 countries from before, you have actually 2 groups for these countries. And their special focus on the age group 45 to 64, because those are those age groups where we typically, as life insurers, have the highest exposure. So mortality in that age band means potential loss for us as insurance companies. Well, let's have first a look to the left side. You see here Austria and Germany. Over the time, you see here the year 2019 compared to 2020. Actually, over most of the year, you don't see too many differences between the 2 years. So 2019 and 2020 have behaved more or less similarly. So it's just random fluctuations around the mean. And you just see in Austria, and that's what we saw, what we've just seen on the slide before, you see a certain peak at the end of the year, well, showing that we have already seen this huge peak in the number of daily infecteds in Austria. And there we've seen a certain additional mortality also in the age group of younger people, 45 to 64. When you compare that to other countries, for instance, Italy, Netherlands, Spain, and Sweden, for all the other countries, you see also already in the first wave that there's a peak. You don't see this happening in Austria and Germany. Especially for Spain, you see a very huge deviation of the mean. And then, well, luckily for the second wave, you see no material increase for many of the countries except for Spain and for Italy. There again, you see an increasing number of death casualties in the age band of 45 to 64. For Italy, it's even getting worse than for the first wave. So again, that's something we have to understand, and anticipate also for the future, for the next year. What does it mean? Do we have additional risks after the second wave, with the third wave perhaps to come in February and March, and how to manage those? How strict should our measures be that need to be implemented by the government? So exactly that's the discussions we need to support as actuaries and help the government or our companies to bring forward the right decisions. And perhaps that's my outlook for the next months to come. It's perhaps two things what we have to learn. The first thing is, in the short term, we have to adapt our processes. So forecasting and planning will have to be done differently in this environment of high uncertainty. Perhaps we need to carry out additional risk management assessments, or so perhaps is needed to run on an ad hoc basis, or perhaps some of the companies already did so this year, and the risk reporting has to be adapted accordingly. So that's something we need to do operationally as risk managers. But when we do that, it's important to remember the three things what I just said at the very beginning of the presentation. We have to be sure that, or we have to understand that not everything can be really modeled and calculated as we are used to. That means that not everything can be planned and controlled that easily as we used to act in the past. And we have to understand that, well, we will make mistakes, or our predictions will be wrong. And again, that's something we have to inform our managers that this will happen, and we have to deal with these mistakes, or these errors, or these misinterpretations. On the other hand, it's not just a problem, it's also it's a very new opportunity for us as risk managers or as actuaries. We need additional methods and approaches for managing this. So one of these methods that I just mentioned is agility. That's something which I personally think is more exciting, and we just again need a broader view of everything to tackle all these different aspects into our presentation of what we can plan and what we need to manage, being as an actuary or as a risk manager in our companies, and then also as perhaps as a consultant in a certain extent for the governments. Also their actuaries can play a role to support managing the risks of a country facing this pandemic. So that was the first part of the presentation. As said before, if you still have additional questions, please type these questions into your chat function. I will copy those and discuss together with Malcolm after his presentation these questions with you and give you the answers if possible. So thanks for participating in the first part of this webinar, and I will give the presentation to Malcolm. So if I find him, where's Malcolm? There's so many participants. Here we are.
Can you see my slides?
Yes, and we see your camera.
Brilliant. Okay, so I shall come off my camera and say welcome. Thank you very much for inviting me to this webinar, and it's great to see many people who've actually joined the webinar. This is the second the Risk Management Committee webinar that we've had in recent times. The last one was a year ago, and we also looked at the risk margin a year ago. it's a very important topic for companies that are subject to Solvency II, which I suspect almost all of our companies are. It's a large number, and there have been a lot of issues raised with the risk margin calculation. And what I want to do is just give you a little bit of an update from where the AAE was previously, and then to delve into thinking about how we can best structure responses and views and thoughts about how the risk margin might be updated in the near future, or what we would like it to look like going forwards. So I just want to cover off, as I said, the background. I'm going to focus on one of the proposals that's been highlighted in the EIOPA Holistic Impact Assessment. That's not yet written in stone as what's actually going to happen, but often what's in the impact assessments have guided further regulatory developments. And what I want to do is to develop a kind of theoretical underpin that isn't identical to what EIOPA has come up with, but is potentially supportive of what they have proposed. And I want to explain how you can apply market consistent principles to get to that outcome. And if the risk margin is changed in that way, then that would guide the way in which it might be changed. If it isn't changed, then there might be scope for companies to develop similar approaches through other mechanisms like internal models, or we could propose some alternative way of accessing similar features or adjustments, maybe proposing undertaking specific parameters and that kind of thing. So I'm going to focus on that bit. That's going to be the core of the presentation, but I will come up with a few further thoughts right at the end. There's a paper backing this presentation, and you've got a link to where it's currently located, and do take a screenshot of that if you wish to look at that straight away. Just a little bit about myself and my background. I chair the AAE Risk Management Committee, so very keen to get your participation in these events, and also your feedback. If there are other topics that you would like us to cover in future webinars, then do please let Frank or myself know. So turning to the background, I'm sure many of you have been involved in the risk margin calculations. It's a very important part of Solvency II. The concept behind the Solvency II risk margin is an exit valuation. It in theory targets a specific way of thinking about how to produce insurance liabilities that kind of run off. You pass the liabilities to someone else. How much would they in theory charge for taking on those liabilities? And there's a specified way of doing the calculation that's set out in the Solvency II delegated regulation, and I've got it on screen there. It currently has a cost of capital component, and that's set at 6% per annum, and you discount future SCRs at that cost of capital, or applying the cost of capital and discount at the risk-free rate. The EIOPA Holistic Impact Assessment was proposed no change. Oh, sorry, the original EIOPA Solvency II review proposed no change, but there was a more recent March 2020 impact assessment in which a change was proposed. It has to be said the risk margin, how it's designed and operated, is a hot topic. It's specifically in scope of the Solvency II 2020 review. It's also in scope in the UK Treasury's review of how to regulate UK insurers after the end of the Brexit transition period. In fact, it's the first topic that is covered in that paper. So the original EIOPA response was perhaps a little too difficult. There was no obvious desire for change, but more recently they've introduced an attenuation factor, as I describe it here, which is this lambda. So what you do is you still apply cost of capital, but you apply it to an attenuated version of the SCR, or alternatively, you think of it as applying it an attenuated version of the cost of capital to the original SCR. And the proposal involves an attenuation which declines for about 25 to 30 years, and then is flat at 50% thereafter. I mentioned that the AAE has already discussed and analysed the risk margin. It came up with a commentary paper which was published right at the end of 2019. This covered the theoretical underpins, was broadly supportive of the concept behind the Solvency II risk margin if one wants a market consistent approach to setting technical provisions, etc. It highlighted that if risks have certain multi-year dependencies, then an attenuation factor appeared to be justified, and maybe that influenced the EIOPA's holistic impact assessment. It was published before the impact assessment came out. It highlighted that if the risks exhibited negative autocorrelation, so if a risk occurred time one, then that reduced the size or likelihood of the risk later on, then the theoretically correct lambda t should be declining through time. And an example of that might be the mass lapse risk. If policies lapse, there's a large lapse, there are fewer policies that can then lapse later on. And it also highlighted that there were a few types of risks, maybe asbestos risks and other non-life long-term liability risks, where the opposite might be true. So in fact, the lambda t would be increasing through time. And so the aim of this presentation, the underlying paper, is to explore what might be plausible lambda t's based on some kind of market consistent underpin that could inform this debate. There's no desire within this presentation to explore whether the cost of capital is at the right level or that type of topic. That was covered in some depth in the this AAE commentary paper, and I would encourage you to go back to that paper if that's of particular interest to you. The paper, the AAE paper, did highlight that there was a further justification for some kind of attenuation to be incorporated in the formula based on how investors view shareholder limited liability. So if there's a very large loss that shareholders suffer, so large that they get wiped out, with limited liability corporate structures, they can't then get wiped out a second time later on. At least they can't unless they go away and invest in something else. So limited liability does create some kind of negative autocorrelation that's not risk specific, but it's probably also relatively modest. So we don't focus on that in this paper or presentation. The key insight of the paper is that one might be able to identify from how standard formula stresses are worded and interpreted, some kind of view about how risks might exhibit dependencies, multi-year dependencies through time. So we'll first of all focus on what the standard formula might tell us. A lot of companies use the standard formula to calculate their SCR, so maybe it's not unreasonable they should use ideas implicit within that in calculating their risk margin. But later on, I'll look at the extent to which the standard formula might or might not provide a full measure of the risks involved. So the key insight that the paper focuses on is essentially that the Solvency II technical provisions are supposed to be market consistent. Once one does that, the risk margin is part of those technical provisions. So in principle, if we can identify something that is market consistent, looks like the current risk margin, then that ought to be what we should target the actual solvency risk margin to look like. So in a market consistent world, and if you assume a given risk is correctly quantified by some kind of loss at a particular point in time, and there's some risk neutral probability of that loss occurring, then you should be able to price that loss or that sort of series of losses through time using the formula set out at the bottom of this slide. So simply the market consistent probability, either risk neutral probability, multiplied by the market consistent loss, and you discount at the risk neutral discount rate, which is here the risk-free rate. So if we compare that formula, the XTs look quite like the SCR, and the Q is constant, or could be constant, and looks like the cost of capital. So the insight here is that the Solvency II risk margin formula looks relatively similar. Indeed, the cost of capital we can identify directly with this Q, the risk neutral probability of some kind of loss, which we're pricing into the risk margin actually occurring. The difficulty is to work out what the XTs should be. So the XTs, and this is what I've highlighted at the bottom of this slide, how do we determine the risk neutral unexpected loss applicable at each point in time in our computation? Those of you familiar with option pricing or market consistent approaches or economic scenario generators or other equivalent tools, essentially what we have here is some kind of binomial tree where at each year end we do or we do not suffer some kind of loss, and that's those losses that we are compounding somehow into the risk margin computation. And it's the losses that occur at each point along that binomial tree that we are interested in. So I've got here the binomial tree expressed in kind of graphical form. At time naught, we assume that over the next year there's some probability of the stress that we're worried about occurring, and there's some probability that it doesn't occur. And then at time 1, we repeat that. Time 2, it'll bifurcate again into 8 different possibilities, 16 the year after, etc. And our challenge is to work out what stress we should use in a market consistent way of looking at the risk margin. So what I want to do just the next few slides is to look at what might be interpreted as the right sort of loss to incorporate if we believe that the standard formula description of the SCR kind of equates with reality, and that the way that that standard formula is worded gives us a clue as to what happens when unexpected losses come along and hit us. So risk margin is pricing. It's saying what a third party would want to charge for taking on board those unexpected losses which contribute to the SCR at any particular point in time. So we kind of assume a stylized insurer that has some assets and liabilities. They're going to depend on the path that the world takes in that binomial tree. We assume that if no losses occurred, then those assets and liabilities run off through time in some shape or form. And most standard formula SCR elements involve some kind of stress factor that are applied to some fraction of the assets or liabilities. Usually the stress factor is the same for both assets or liabilities, or the stresses only apply to one side of the balance sheet. So insurance risk, for example, lapse risks would typically apply just to the well, it could apply to both sides of the balance sheet, but mortality maybe would be more likely just to apply to the liabilities. So we, in this kind of stylized way of looking at things, we can ask the question, what happens if the stress occurs just in the first year? And then life is relatively simple. To take some kind of market stress is perhaps easy to understand, maybe unit linked business, and we assume that this is not actually hedgeable by the reference undertaking. Most market stresses are, so this is kind of a relatively hypothetical example, but it gives you a flavor of how the computation might work. So the assets fall by a certain fraction, maybe not all the business is subject to this stress, and likewise liabilities. The overall stress for the SCR is the movement in own funds, so assets minus liabilities, and you come up with a formula that's set out in the middle of the page, which would indeed be what you would use to calculate the SCR. It's the same stress as would have contributed to the SCR for that risk. So for that risk, in the kind of unexpected loss that's going into this market consistent risk margin is actually just the same as the SCR. So it contributes Q, the risk neutral rate, times likelihood of occurrence times the SCR, and then you have to discount it, of course. So it's exactly the same as in the current risk margin formula. So at least for year naught, we get the same answer as in the current formula. But for year one or year two onwards, it's slightly more complicated. The tree that we showed at the end of time one, you've got two different possibilities that have occurred. So what we need to do for year two onwards is consider what's happened prior to reaching that point. If there was no stress that occurred in year one, then the logic that was set out in the previous slide flows through essentially unchanged. And so again, the unexpected loss that we would price into our risk neutral or market consistent risk margin is the standard SCR as in the current risk margin calculation. But for branches where there have been a loss or a stress has occurred, then it's a bit more complicated. And as one goes further and further out into the future, there'll be more and more branches, more and more possibilities. There'll be a certain number of stresses that have occurred in the past. So the tree will get potentially more complicated. What the paper highlights, though, is that we can approximate nearly all of the possible ways in which that binomial tree might operate in 3 different cases. So the first case is where the same absolute fall hits us every time an unexpected stress occurs. So we have a stress end of year 1, further stress in end of year 2, and that further stress would have been the same whether or not there was a stress in year 1. The second is cases where it's the same proportionate fall. So if the stress was 30% year 1, the assets and maybe liabilities, or at least one of them, has fallen, then the next year it's 30% of the reduced asset or liability amount. At least it is if the stress is one that reduces the assets or liabilities. And then case 3 is that once you've had a stress, you never have the stress going forwards. And for market risk, the most plausible case that you might apply in this situation is case 2. If the index is 6,000 and unexpectedly falls, we price in that in the risk margin calculation by 30%. It's by 1,800 to 4,200. The next time it happens, suppose it happens twice in 2 years, probably isn't going to be another 1,800. It's just going to be 30% of the 4,200. So it would only fall by a further 12,600. But it's also implausible to assume that it never falls after it's reached that 4,200. So market risk would seem most naturally to fit into case 2, but maybe the other risks don't fit into case 2. Maybe they would fit into case 1 or 3. What I've got here is a little chart that expands out that binomial tree into those 3 cases. And the further insight is that in most situations, you can do the numbers and re-express the formulae analytically, and you come up with a result that's exactly in line with the EIOPA holistic impact assessment, but with a lambda t that takes the form that I've shown at the bottom of this slide. So it kind of exponentially alters by this factor 1 minus the cost of capital times an S, where S is typically the size of the stress. And so that means there are, well, actually 4 cases that we need to worry about, because case 2 splits into 2, depending on whether the S is positive or negative. And there's a little chart that shows how the lambda t would alter as one went through the projection period for the risk margin. And this slide just explains how it is that you manage to come up with the same sort of formula or some simplification for the attenuation factor that is got a similar form for all 3 cases, just with a different S included in the computation. So one can then say, well, let's consider all the different risks which actually contribute to companies' SCR, and identify what might be the most appropriate attenuation factors, or indeed, as we've seen, the S's that might apply to those risks. What this table does is it focuses on selected life insurance risks. Typically, life insurance liabilities have a longer duration than non-life. So the risk margin disproportionately comes from life insurers rather than non-life insurers. And I've set out here the different sorts of risks and some views based on how the standard formula SCR stress is worded for those different risks. So market risk typically is assumed hedged in the risk margin computation, so typically doesn't contribute, but to the extent it did, S is positive, which implies the lambda t declining through time, somewhere maybe between 0.1 and the maximum possible is the type 2 equity when the symmetric adjustment is also at its maximum level, which is 0.59. Counterparty default risk probably similar, but with a probably smaller S factor. Mortality risk may be closer to case 3, but it's not 100% easy to work out from how the SCR is worded, but it would at least be case 2. Longevity risk would typically, the stress would actually increase the liabilities, so it's got a negative S, so it's also not so easy to work out where that would lie on the spectrum. The expense risk, that's specifically applied at all future points anyway, so maybe it is close to case 3 if it hits once, maybe it only will rarely hit further down the road. Mass lapse risk is many people I think would view it as a case 2. Typically the stress is a 40% lapse, and that would take out your assets and liabilities to the extent that the stress applies to both. But for certain forms of institutional business, it can actually be higher than 40%. Operational risk, there's little indication of in this the Solvency II standard formula wording exactly how we might interpret that. Maybe that's close to case 1 if we follow the logic of assuming that the wording tells us something about the right way to calculate this market consistent risk margin. So looked at overall, you probably can justify an attenuation factor that's somewhere between the case 1 and the case 3. So somewhere between flat at 1 or declining at the maximum that it's sort of plausible to assume it could decline based on the analysis I just set out would be the cost of capital rate, so 6% per annum. There's no obvious reason to impose a floor the larger T becomes. So the EIOPA holistic impact proposal does come up with an attenuation rate that's somewhere between the 1 and the 0.94 to the power T, but it also includes this floor, so it's not obvious to me why that floor is theoretically justified. As I said, the AAE paper refers to a possible non-life counterexample where we might expect some positive autocorrelation to liability risk like asbestos. The specific way that that risk is captured in the standard formula is premium related and wouldn't therefore actually change. So to the extent that there is sort of time dependency, the logic that I've just set out would put it into case 1, but as was explained in the commentary paper, if that type of risk comes along, actually crystallizes, then often it means that further down the road other related risks become other losses become much larger too. So probably case 1 is too optimistic for that type of risk if one were thinking about the intrinsic risks of the intrinsic features of that particular sort of risk. So that highlights a challenge with what I've just set out, which is that the way the standard formula is worded may not be a perfect guide to how we should set a market consistent risk margin. The stresses weren't formulated with that specific use in mind. And what I want to do in the last few minutes of the presentation is just to run through some of the ways that one might look at those risks from a more intrinsic perspective, and some other things one might draw out. So moving away from the idea that how the standard formula SCR is worded might provide all the answers. So I just explained there are certain sorts of risks where if we followed the logic that I've set out earlier, we'd conclude it was a case 1 type of risk, but that might be too optimistic. It seems to understate the intrinsic contribution that that type of risk might make to a market consistent risk margin. For other sorts of risks, operational risk, difficult to call, and indeed that was highlighted in the AAE commentary paper. Maybe zero attenuation is too cautious if past operational risks incentivize future improvements in the operational risk framework, or maybe the other way around if what it highlights is that there are hidden control weaknesses waiting around the corner to come to light. A lot of people think that longevity risk shares some similarities with mass lapse risk. You can't, quotes, cure the same cancer twice. So maybe that would be a justification for, again, some attenuation being applied there. Conversely, the stress, if it applies, would typically increase your liabilities. Most of the non-life risks where the standard formula specification refers only to premium income, which is what happened with the asbestos type liability risk. They tend to be relatively short term in nature, so it looks as though the long tail liability risk is a bit of an outlier in terms of risks that ought to have an attenuation factor that in fact increases through time, so the lambda t goes up rather than down. And looked at over the whole industry, as I said, life insurers tend to have longer duration liabilities than non-life insurers, and looked at over the entire spectrum of risks, it does seem to me plausible to have some kind of average attenuation, the lambda t actually going down through time, somewhat akin to the EIOPA proposal, albeit not flawed at 50% for very long dated risks. That's looking at the industry as a whole. We might decide that it's not appropriate to apply a single lambda t across the entire industry. It does seem to vary according to the risks. It would be possible for some firms to use, or indeed some firms use an internal model to set their SCR, and we could consider the possibility of allowing firms to include a lambda t in their internal model. At least that's what the paper proposes, but it's occurred to me that it's also possible that some firms already implicitly do that within an internal model. So if there's anybody here who works for an internal model firm and you actually are using in effect an attenuation factor in how you accumulate your SCRs to reduce the risk margin, then it would be helpful for you to share that. And in effect, what we're doing then is we're broadening the scope of what we mean by an internal model away from just how you calculate the SCR to also how you imply the SCR within the risk margin calculation. Internal models involve an awful lot of governance and effort, and many firms are put off by that level of complexity. We could achieve a similar broad overall kind of equivalence by introducing some kind of undertaking specific parameter that you might also go and get regulatory approval for. You could also seek to extend the also SCR appropriateness to cover whether the risk margin calculation was appropriate. It would seem a natural kind of way of thinking about what I just described. And the concepts that are set out in this paper, I've seen other people kind of come up with things that look relatively similar, but maybe less less kind of theoretically worked through. I've seen people talk about a loss absorbing capacity of the risk margin, and those concepts do seem to align relatively well with how I've described building up a market consistent risk margin. So just to summarize this presentation, the risk margin is a major issue for some insurers, particularly life insurers with long duration liabilities. There is this proposal to introduce an attenuation factor, and the insight within this presentation and this paper is that we can use market consistent logic and principles, and we can apply them to that problem of what that attenuation factor should be. Typically, it looks as though it should be an attenuation factor somewhere between flat and declining at 6% per annum without any floor after a very long period of time. We can use the way that the standard formula SCR is specified to help us or guide us with choosing that attenuation factor and where between 1 and 0.94 to the power t it should lie, but it's only imperfect, that guidance, and there are certain cases where it doesn't seem to work really well. And if we didn't think that we wanted a single attenuation rate for all risk classes, then there are a variety of possibilities, extending internal models or undertaking specific parameters. And what would be helpful during the Q&A, if there is time, is to, if you had any views as to what you thought the AAE should be doing in this space, how it should be influencing the debate, whether you thought that what's just been described is logical and sensible, and what else you might put into the melting pot in terms of any views the AAE might make to authorities and the Commission, etc. So that, thank you very much indeed for your attention, and I'm looking forward to some Q&A now. So Frank, should you take back control?
Yes, I will. So I need to find myself. Here we go. So thanks, Malcolm, for your presentation. So the last 30 minutes, we have already gathered some questions for Q&A. And if you have further questions, please keep on writing those into the chat function, and I will then just read those. For the other questions, I have prepared the slides. So perhaps first to my presentation on COVID-19 as a risk manager, I received two questions. The first question was, do you expect an increase in health costs and mortality in later years as people do not visit doctors at present? So what we already see for health costs, for instance, is that already for the first half year, the health costs that were reduced for the first 6 months, they were kind of higher already in the second half. So we've seen already a certain increase of health costs in September, October, and I guess that similar effects will also be observed in the next year, that some of these treatments that have been postponed will then increase the health costs in 2021. And that's something we observe in several European countries, that we have low health costs in 2020. And for all those countries, I do expect that to happen, that these health costs will more or less be transferred to 2021 next year, and will just increase the average health costs in 2021. If this is also happening with mortality, the only thing what we have seen is, and that was one of the discussions we had during the first wave, that, well, it was kind of expected that people that died didn't really die only for COVID-19, but they had some preconditions already, and if they hadn't died of COVID-19, they died perhaps 2-3 weeks, months later for the other preconditions, and that's actually what we do not see. So when you look into these timelines of Euromomo, remember the time series I showed for the 6 different countries. So if we had seen kind of a increase in mortality that is compensated by people then kind of dying just earlier, but then they would have died anyway, we would have seen a decrease of mortality rates afterwards, and that's not observed. So at least the one thing what we can state, and that was what we can observe, is that the mortality rates are at least stable in the future years, in the future months. If people have increasing mortality rates due to not having visited the doctors and not having done their examinations and treatments during 2020, that's very difficult to predict. So that's what I don't know really, if we would see coming from that an increase in mortality rates in later years for not having adequate treatment or adequate examinations done in 2020. It's hard to predict. That's really difficult. To the second question, the reputation topic. The question was, I'm interested in the German market. Do health insurance products include the condition except pandemic? I have seen examples that people are not aware of this exclusion when they signed a contract, and they are then frustrated that there is no cover. Well, for health insurance, sorry, I do have a typo there. For health insurance in Germany, there is no exception of pandemic. So every treatment is covered, and you cannot really, it's not really possible to exclude pandemics. But we've seen in Germany this situation, especially for P&C. So for business closure, actually business closure insurance has an exclusion of pandemics, and or actually putting it the other way around, there was a definite and closed list of illnesses that were covered, and that did not include, because it wasn't existing when the contracts have been signed. It obviously didn't include COVID-19, and so the discussion was, as business closure should have been there for epidemics and then also for pandemics, but it just covered a closed list of illnesses. The question was, is that then, if the name kind of, well, could be understood as covering epidemics and pandemics generally, can there be this exclusion of COVID-19. And that's still an ongoing discussion in Germany, for instance. And there is this frustration that people expected a coverage, and they haven't really understood that there was an exclusion for COVID-19 in their contract. And then also this exclusion is difficult in a legal way, so it's really depending on the precise wording. So some wordings were strong, and there it's clear that it's excluded. Some wordings, treaty wordings, weren't that strong, and there really is the discussion still going on if these exclusions are really, yeah, can they be kept, or do insurance companies still have to pay these claims? So those were the 2 questions for my presentation. I have also 2 questions for Malcolm's presentation, and the first one is a bit longer one. I will just very briefly read through it, and then perhaps Malcolm could answer. The level 1 text states that the SCR is the capital necessary to support the liabilities over the lifetime thereof. This implies that the SCR is simply the maximum amount available to fund unexpected losses over the lifetime of the liabilities. The idea of attenuation is based on the notion that the risk margin should enable the RU to raise capital equal to the SCR each year again. This idea appears to have gained traction over the years, but it is nowhere stated in the Solvency II legislation, level 1 or 2. Moreover, this notion would give the risk margin more the character of a contingent capital arrangement, with the probability of having to raise capital over and over again being very small and not reflected in the valuation. This is very different from the notion of market value at the time of transfer, when the best estimate scenario is that no additional capital will be needed. What do you think of it, Malcolm?
Okay, the idea of attenuation, indeed any lambda at all, is highlighted in this question, but it doesn't. The question I think assumes that if I kind of understand this correctly, the question is what sort of attenuation should be provided. So the way that I look at what's just been set out here is that this questioning whether the intrinsic way in which the risk margin should be calculated or is calculated is correct, rather than the level of the attenuation itself. So I was trying to justify in the paper attenuation rates somewhere between maybe a flat 1 or a declining 0.94 to the power t. So leaving aside that, you then get into more intrinsic and fundamental questions about the risk margin, what's its purpose, how ought it to be calculated, and the delegated regulation does have a kind of concept underlying it, and I would agree that there's a step change that occurs between the level 1 text and how the Solvency II risk margin computation is currently set out in the level 2 text, and that does require a view to be taken as to how you interpret the risk margin intrinsically. So the AAE commentary paper in December 2019 did look at the kind of intrinsic kind of concept of the risk margin. It I think was broadly supportive of the EIOPA and the EU Commission continuing to run with something that looked, roughly speaking, akin to its current shape, i.e. that it did seem logical within the framework set out to have this kind of the concept, the contingent capital arrangement, as the questioners highlighted. So a broader question is whether that's appropriate. For example, the insurance, the International Insurance Capital Standard has a potentially different way of interpreting its equivalent of the risk margin. That's the MOCHI. So it's not taken as given that that's the right answer. So my paper and the presentation was assuming that that's the framework that you want to adopt, and then within that framework, how should you set the attenuation? Should it be flat, i.e. no attenuation at all, or should there be some attenuation through time? I think the final point that's highlighted here, the risk margin, more a kind of contingent capital arrangement, very different from the notion of market value. At the end of the day, the concept of the risk reference undertaking is that it will buy those liabilities at a price that's supposedly consistent with the cost that would be incurred. So it is in that sense inherently market consistent, which is linked to market value. I'm not sure. I think it is as different as maybe that third paragraph is highlighting, because I think in a kind of market consistent world, the difference between contingent capital arrangements and other ways of coming up with market or market-like valuation ought, in principle, to be similar. But conscious that may not have answered the question. So if the questioner wants to come back with further elaboration, then I'll endeavour to elaborate further on it.
Okay, thank you, Malcolm. We have 3 more questions.
Oh.
Second question was, as lambda depends on the risk profile, would that mean that it could be calibrated differently for each company, especially if an internal model is used? This is not yet foreseen by EIOPA. So you have this topic already, or you had this topic already on your slides, but I think when the question was posed, those slides weren't up yet. Perhaps the last sentence, is that already foreseen by EIOPA, that internal model users can have different lambdas for different portfolios?
I've not seen that specifically from EIOPA. The Solvency II review hasn't finally landed, so there presumably is scope, if we believed that that was an appropriate way to develop things, to encourage the development in that direction. So I think in theory, I would support that concept, as the presentation argued. In practice, I can see that it adds complexity. So there's a trade-off between theoretical nicety and complexity, and we can have views on that, but ultimately regulators and politicians will also have views on that.
Mm-hmm. Then the third question was, do you have an idea what can be lambda for non-life?
Yes, so some of the risks I highlighted, although I expressed them as life-focused, do also apply to non-life. So the expense risk and the operational risk apply to the non-life companies as well. And I don't think there would be necessarily any material differences there. For pure non-life risks that are kind of unique to non-life, quite a few of them are premium related. The SCR formula is kind of premium, got a strong premium component, and if the premiums are already paid, or maybe they're half paid if you're halfway through a year's contract, they aren't necessarily going to move very much, or in a sense, the multi-year dependencies kind of fall away. And as I explained, for certain risks, that seems intrinsically too positive, or too optimistic, because for things like asbestos, what in practice did happen was that you had a few court cases that established the principles, and all the claims thereafter were much higher than they would have been if you hadn't had those court cases. So there's a kind of positive autocorrelation between claims to the extent they do actually arise. So I think for some non-life classes like that, you might well see this autocorrelation. But the ones where the duration is most of those don't have a very long duration. So I think it's probably the attenuation factor would be smaller on average for non-life businesses. If they have a particularly large long tail liability book, it could even be around a flat attenuation of 0, so the lambda being 1. But I would encourage whoever's asked that question to work through what I've described for the sorts of risks that might be within their own book.
Excellent. And then the last question, when is the application of the attenuation factor expected to be implemented by insurers in the risk margin calculations? I guess that's something we can do not before we are through the review of the 2020 review, or can we early implement something like that?
In terms of the specific computation, the risk margin, that's set out in regulation. When and if that changes is ultimately down to our political politicians and regulators. So that, I think, is a question that is not one that I know the answer to, or I suspect no one yet knows the answer to with any degree of precision. What I would highlight, though, is that within not all firms are constrained by their Pillar 1 computation. Some are constrained by Pillar 2, the ORSA. The ORSA is, of course, your own risk and solvency assessment. You don't have to follow the same way of calculating your technical provisions as is done in the Pillar 1 computation. So within an ORSA, if you thought that the equivalent of the risk margin that was included in that computation was overly prudent, then presumably you could already, and you could have already for some years, have adopted an alternative way of viewing your technical provisions, and therefore an alternative way of coming up with the end answer. So you can, when it comes to the Pillar 1, the implementation is driven by how the regulations are set. For Pillar 2, there's greater freedom. And for Pillar 1, I mentioned the idea of expanding internal models to cover how the SCR gets accumulated into the risk margin within the internal model. Since the internal model as a whole is subject to regulatory approval, it might be that firms already do some of those kinds of things within their internal models, but I'm not aware of that myself.
And the second part of the fourth question is perhaps also similar to the third. Secondly, how do you expect travel insurers to approach the attenuation factor in the risk margin calculations, considering the short tail nature of their business?
I haven't looked at how travel insurance, the precise way in which it's the SCR applies for that business. So I don't know the answer. For very short tail business, the risk margin shouldn't be more than a few times, 0.06 times the SCR. So it'll be driven, so it will ought to be relatively small compared to the SCR itself, which is why I focus the presentation on longer term business.
Excellent. So thank you also to you for participating and writing your questions into the chat function. Those were the questions I've been copying in the slides. So thank you, Malcolm, for the presentation, and thank you all for participating. What we really like is get your feedback on the presentation and on the webinar. So please make sure that you give us your feedback that we can improve our webinar. So today was the second one, so third one will be next year, and again improve from your feedback. So thank you for joining today, and stay healthy, and have a great Christmas, and well, perhaps already a good start in the new year, and hope to see you soon then next year again. Okay, thank you.
Thank you.